Hi, this is Randy Finney with Right Side of the Chart, and this is a pre-closing market wrap for Tuesday, July 7th, 2020. I'm going to call it a pre-closing market wrap because I'm starting at 3:28 p.m. Eastern Time. If possible, I'd like to get it out to you guys before the close. Nothing earth-moving, nothing big, earth-shattering or anything today. Just some things I wanted to mention on the broad market. We'll look at I just want to look at the sectors of the S&P, look at some updates really to the 60-minute charts, and let's start there. Let's just go to the 60-minute charts and mention that we do have the breakdowns below those minor trend lines I posted yesterday. This is SPY. We have one little whipsaw candle through there, but other than that, it's a very well-defined trend line. Broke down, nothing impulsive, and not at this point, at least, not the ideal sell signal, but it is a breakdown nonetheless. And what I think we're at right now, and this is why I want to do the update, is support right here. Remember this multi-week trading range right there? We had broke below it, went back above it, popped above it recently, but now we're sitting on it again. Call it what you want, but I can say that's a pretty decent, not super solid, but a decent support level, and about 314.83. So that coupled with these recent breakdowns, sometimes you get that. Sometimes you break down and you just go, like back here on that June 11th gap down. Sometimes you break down and then you need to take out a horizontal price support level. Again, the markets aren't super conducive to trading. I do these videos to show you what I like, and if you're want to trade this week, these are levels that you might want to watch. So break of that 314.83 should do the trick. We also broke down on the Qs. I'll get to that in a second. If we pop back up, maybe look for another run at this 318.87. In fact, we never hit it. There's that gap on SPY, and there was talk of that earlier. So that's the top of the gap right there. It's around 318.77. So we've yet to even backfill that gap from June 11th. Keeps those sell signals I talked about earlier today intact, but again, we didn't see the ideal follow-through selling. We've been in this sloppy trading range, so make of it what you will, but I'll point out we have the bearish PPO crossover there as well. We had the RSI divergence as shown right there, and that's it. So nothing earth-shattering here, nothing huge, but some near-term sell signals. And most importantly, we've also taken that out on the Qs. QQQ, there's our trend line, fairly well-defined uptrend line, and there's your sell signal right there. Whether it plays out or not, time will tell, but that's if you're looking to game pullbacks, if you're looking to buy dips, you wait for these breakdowns and you get these near-term sell signals, and they're usually good for corrections of at least a couple or a few percentage points. And if you're actively trading and you're let's say you're using something like NQ or a leverage instrument, and you're in and out, a day trader or a short-term swing trader, 1, 2, 3% is certainly putting some pennies in your pocket. Speaking of pennies, or let's talk about nickels, the trend is up. Make no doubt about that. And I keep pointing out levels that if you're bullish, you can buy these pullbacks to these support levels. I may continue to maintain, I think it's picking up nickels in front of a steamroller. The divergence is building on the daily chart of QQQ, the weekly chart on QQQ right there. Remember, if this line turns down, we'll still have divergence here. The PPO line right there, the blue line can change. There's clear RSI divergence, and this is the faster moving line. That can turn back down. The slower line is the 9 EMA right there, the signal line. And this is what QQQ looks like. Just continue to move that up. And as I often say, the Qs are not the market, but let's look at the market. Let's go back to SPY. SPY is the stock market. If you're going to talk about how's the U.S. stock market doing, this is the stock market, not QQQ. It's a combination of the small caps, mid caps, large caps. So here's SPY, still well below the all-time highs, as are the mid caps. That's MDY, tracks the S&P 400 mid cap index, still well above the highs. In fact, just like the small caps, they really peaked. Actually, we might have had a slightly higher high in 2020. I take that back. I was about to say small caps peaked back here in 2018. We had a slightly higher high on the mid caps, and they're still comfortably below that all-time high back from February, about 16% or so below that high. So that's where we're at there, mid caps. So really the stock market is a combination of all of these, and of course the Dow. There's I'll get to the Dow in a second. Mid caps below their high back in 2018, still down about 19% or so. And the Dow, you can use DIA, tracks the Dow 30, and that one is still well below there. So I say that because I'll see comments from time to time about it being a runaway market. The Fed, is pumping the market up. No doubt, a lot of this it was technically induced off the bottom of the bounce, but undoubtedly a lot of the lift. I think really this part here, had the Fed not injected so much liquidity, I think this is probably about where our bear market rally would have stopped. And so now, so far. And you can look at the Dow trading below. It had briefly taken out the 200-day simple moving average, the blue line, and the red line below is the 200-day exponential. And we're back below that, bouncing against, having a tough time taking out the 200-day simple moving average, or at least holding above it. And just like the S&P 500, the Dow put in an island cluster top recently right here. That color doesn't show up well, but you have right there your island, box it in. And just like the Dow or S&P 500, you had a gap down below it to put the island cluster top in, sell signal, and you've been trading in the trading range. So that's what I wanted to get into, is that the fact that just continue to try to impress that this is the stock market. This is what the stock market's doing, not QQQ. You want to trade QQQ, you're really trading XLK. You're trading the tech sector. You're trading tech stocks, or they nearly mirror each other. And let's talk about that, because as I often say, until and unless tech breaks, the market doesn't break. There it is. There's your negative divergence right there on XLK. It continues to build. We had divergence yesterday. We had it again today. We had divergence right there. Played out for only a little pullback. That divergence simply was extended, and it's still very much intact. And so the yellow line is really probably the most important level. It's this recent support shelf right there that was defended about 101.79, and as I was saying back there, that level needs to go, and it needs to go with conviction. It means either a very solid big daily move down below there, or ideally a solid close below there as well. And that's that. Now we're going to rifle through the 11 sectors, and maybe not all of them. We'll just hit the big ones. XLK, as you can see, it's over 25% weighting in the S&P 500, and it's almost 50% of the NASDAQ 100. XLV is an important sector as well. Healthcare makes up almost 16% of the S&P 500. As I go through this, I'll mention that the top weighted sector, again, it's all been about tech. That is the only sector, only one, that's trading at all-time highs. Everything else peaked back here in January and still below that. There's XLV. You can see a little downtrend line off those January highs right there in XLV, and that downtrend line's resistance. So that's where we're at. Let's look at the next one, XLF. This is concerning. This is the financial sector. As I mentioned, the financials have been significantly lagging. That is not a good sign. This whole the whole economy, U.S. stock market, the whole financial system is, I don't want to sound like one of those, doomsdayer and call it a Ponzi scheme, but to a large extent, I can tell you that it is somewhat of a house of cards built around the financial system and the banking system, and Fed obviously is a big part of that, and it just tells you what's going on here. I think this tremendous divergence between the tech sector and what I believe to be just a crazy misplaced belief that the tech sector is impervious or immune to the economic cycle, the business cycle, that is economic expansions and contractions. We are in a contraction. We've had the economic indicators fall off a cliff. I'll just loop back to XLK. You can do this at any point in time. Go back, pull a long-term chart, look at stock market drops and corrections. Look at the last bear market back in 2008 through 2009 when the tech sector fell 55%, right in line with the stock market. Make no mistake about it, tech stocks are very cyclical. There's just something else going on right now. A lot of, I guess, who knows, liquidity injections by the Fed. They are, they're supporting, they're buying bonds, their bond buyback program, or bond purchase program, I'm sorry, from the Fed includes big names like Apple and all that don't even need the support but are getting it from the Fed. And that's a big part of it. So you're probably saying, well, why fight the Fed? Look, right now we don't have any sell signals, and we haven't for a while. We need to break those support levels, but I think that's when we finally reverse trend and the whole market, the broad market, which is really holding up, as I showed you, the S&P 500 being the market, is holding up. But when we do get another leg down, whether we go up first or not, I think tech will lead to the downside, especially if there's another big leg coming down the bear market, which I believe there will be in 2020, 2021. So again, it's just more profit potential. Let's, in other words, shorting tech versus shorting, say, utilities. Let's go through the remaining sectors. So there's XLF. Wanted to point out, which I mentioned on the homepage today, looking very weak, significantly lagging the broad market. Again, this is unusual to see such a drop, especially between tech, and it's bouncing. It's holding support here around 23-ish. We have this consolidation period just below. And again, that's just something to note, and it speaks to the bigger picture. On the weekly chart here, tech broke down below all these trend lines, back tested this key trend line right here. I'm referring to this one. You can see the the breakdown and back test recently. That's a bearish long-term chart. That came off a big divergent high, and the fact that the banks are lagging so much reminds me a lot of, and I encourage you to read up on this if you're not familiar with Japan's lost decade. They had a very similar asset bubble that really big part of that was a real estate market, but not everything. And that bubble popped back, and they had what they call the lost decade from about 1991 to 2001. Actually goes on to tell you it's really two lost decades when you look at what was lost there. Very similar response to their asset bubble that created by the central banks, where their central bank came in with low rates, liquidity injections, quantitative easing, all that kind of stuff, and you can see where it got them, and you can take a look at the Nikkei long-term chart. And they talk in there about zombie banks too that were created from that whole mess. And so again, I'm watching the financials closely, ugly-looking charts, and it's just a tell to the market. At least it should be concerning as to why tech stocks, and only tech stocks, seem to be roaring on fire when every other sector, we've covered XLK, XLV, the second largest. I'm going through these in their weighting in the S&P 500. XLF, way down here. XLC, communication sector, or you can just say two stocks, Facebook and Alphabet, because they make up 44% of this sector. XLC is the tracking ETF for the communication sector. Another one, it's close, but it's off its highs back from February right there. Big divergent high, big drop. And like the broad market, it's been in this trading range. So look, this can go either way. If it popped that level, they're going to make a run at, and they might take out that previous high. But if they do so anytime soon, in fact, they already have divergence today. We had made a slightly higher high from this previous high here, and that did put in this divergence right here. So should they take out today's high and make a marginal new high, especially a little bit above that, and then reverse, it'll only extend the divergences there. So if you're wondering why I'm not focus on jumping on the broad market, first of all, you have to understand it's not my type of trade. I like swinging inflection points, get these turns. I like to get in at tops and bottoms, sometimes continuation patterns in a trend. But when I see a security poised to break out to all-time highs or new highs, and I see it overbought or near overbought and negative divergence, much more often than not, those breakouts fail shortly after they happen, and then I'd rather sit back and catch the reversal once we get a sell signal there. What would that come in? Many forms. Back here you see this little doji right there. It looks like an evening star doji was left up by itself, and then the sell signal came afterwards with those two red candles and the gap down. So that's XLC again, the fourth sector. This is number 5, XLY. There's 11 sectors total in the S&P 500. XLY is consumer discretionary, or you can just watch Amazon. It makes up about a quarter of the sector because of its oversized market cap. So that's another one right there, trying to break out the new highs, but yet to do so. So again, common theme here. Technology, that's it. This is certainly been a nice rally off the lows, but the market is still yet, the stock market, the S&P 500, the Dow, the small caps, mid caps, none of those have taken out their highs. And again, this is one of the better looking sectors. XLI, industrials, well, that kind of gives you an idea of what's going on in the economy as well. your industrial companies, and still well off the highs, about 20% or so off the highs. XLP, this is consumer staples, makes up about 8% of the S&P 500. Another one well off its highs, and like the S&P 500, stalling out. So look, here's what the way I see this is, those looking at things glass half full, optimists looking for a move to new highs will see this, and it may be that. I don't think it is, but it may be proved to be that a level of consolidation soon to be followed by an upside breakout, and maybe propelling the this sector and the market up to new highs to take out those highs. Or that's it. This was a bear market rally. It's run out of fuel. It's not going down, but it's no longer going up. And if this breaks to the downside, like everything else I just showed you, financials and other things, and the S&P 500, then that's likely our next big trend right there. Until then, swing traders, you're going to get chopped to pieces in this market unless you're very active in and out. So like I've said for weeks now, I've cut back my trading. Summer months, summer doldrums, and it's just not a trending market. It's a sideways market. And I'll continue to try to find individual setups. I like to look at things that have attractive risk-reward profiles, even if they're not on fire. Commodities, agricultural commodities being one of those. Things like that. There's other places to make money besides the broad market. Right now, it's like trying to squeeze water from a rock or blood from a stone to trade, successfully swing trade the broad market. XLE, energy sector. Well, this box here is really this. It shows this gap from back here in March, and we popped it, took it out, almost hit that 47.78 resistance level, fell back in there, and we're back to that level, which is significant. Kind of like the financials, it's sitting on support. If we go much lower, that's a breakdown of support on the XLE. Now, XLE doesn't have the impact on the S&P 500 that it used to. Energy sector has been in a bear market for many years now. In fact, I have to roll back to a longer-term chart. The energy stocks peaked back in 2014 and have clearly been in a bear market since, and so far off the highs, it's really not even worth measuring. It's off their previous highs. They're down about 65%, despite what seemed like an impressive rally off the lows. Just a bear market rally so far. All right, a couple more. I might as well just finish them out. XLU, utilities, kind of grinding around like the S&P 500. They're not going to move the needle no matter what they do on the broad market. You can trade them on your own. XLU long. STP, I think, is the 2 times short utilities. So you can use those if you can't short stocks. I don't see. It's not a lot of meat on the bone when you trade the utilities. You have to just leverage it up a little more, take a larger than usual position size. There are times they can move when the charts are really set up, but not right now. I don't see a big play there. XLRE, real estate sector, same thing. Kind of choppy, sloppy charts. I don't want to spend much time on it, but still, like everything else, well off its highs. So there's a common theme. That's about 16, 17% off its highs. Finally, last but not least, the 11th sector in the S&P 500, ranked by their the weighting is XLB, basic materials. Another one well off its highs right now. And in an uptrend off the lows, if you look at it that way, no doubt about that. Off the March lows, you have this uptrend working its way here. If I can get the right color so you can see it. Sometimes these drawing tools just give me a hard time. That's it. All right, so in the bigger picture, we're not going to do it now. We look at the weekly charts, and that tells us, again, a lot of these sectors ended with divergences at the recent highs or broke down from wedge patterns, and it looks to be a kickback rally. To me, a snapback rally that's carried to the high end of where it should have or should if we are going to take another leg down in a lot of these sectors in the market. Let's look at the futures. NQ, as I mentioned this morning, broke down to that minor trend line right there. There was our breakdown, back test, put in another divergent high, or extended the divergence that was in place at the last high, starting to move lower. I'm going to say minor resistance here. So minor I don't have a line, but I'll just tell you, if I put the crosshairs there, it's about 10,532. This is our first decent support, 10,469. So pull back to that level. If you think these divergences will get burned through and we're going to go higher, that's where you could step in and buy. If you're looking to short or already shorted on the trend line break or the back test today, that would be your next objective entry on a break of 10,469.80 or so. Target down here. This is a support zone. I'm going to widen it up a little bit to come in and catch that reaction high. That support zone runs from about 10,336 to about 10,290 right there. And again, this is, talk about this. You have these on the 60-minute chart here. I'm going to go back to 3 months. We've been stair-stepping higher for months now with these divergences. Let me come back out to 2 months there. And each of these so far have been little pullbacks, relatively small, some bigger than others. To get the divergent highs, correction, divergent high, correction, 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 divergent low. I was bullish. And based on what's going on the daily and weekly charts, one of these divergent highs may prove to be more than just a little pullback. We'll see. Right now, like I said, I can't make a screaming case for that. But depending on if and how the next pullback develops. In other words, do we smash right on through that level? Do we smash right on through that next support level? How impulsive is it? Do we start to see trendline breaks? And most importantly, I haven't revisited them in a while, but the FAANG stocks, let's not forget. I've been saying for weeks and months now, until the FAANGs break and tech, the market doesn't break. And so you still have Apple above trend. Let's see if these trend lines will load. There's the yellow trend line. Microsoft well above trend. There's our yellow. These yellow lines are what have to go right there. Divergence simply extends at this point. Amazon still well above trend. These yellow lines, and Alphabet. So Alphabet was one of the few that broke down and has back tested. So that's the yellow trend line there. And we had a little whipsaw down below that 1398 level and rally back up to make a back test there and simply extend the divergence. So what I'm saying, it's the same thing I've been saying for weeks. The charts are set up indicating another big trend reversal is likely with these divergences. They played out there for a relatively small correction. When I say relatively small, from that last divergent high, I'm just using the measuring tool. I don't want to move the lines. That drop was about 8% in Alphabet. And the only thing that's changed is the divergence is larger now. We had that first drop, and we've extended the divergence to this point right here, and backtesting, setting the stage for an even larger drop. There's Alphabet, the other share class right there. Same thing, divergences get extended. And Facebook. Facebook gave us a whipsaw for sure as well. We had that 222.78 level, which broke down, and that gave us a sell signal. But the following day we reversed during the day and then moved back up and gained it. And we also, what we didn't do is see the majority of FAANGs. That's what I've been saying for months now, is that you don't need to see one FAANG stock break down. You need to see the majority. That's 3 or more of those companies break down, especially Apple, Microsoft, and or Amazon. When those 3 go, those are the biggies. That's when the market goes. So that's it. Those are the levels to watch. ES so far reversing pretty impulsively off another failed attempt at 31.75, a pretty big level. Remember that includes that island cluster top. You don't see it as an island cluster on the futures, but that's where it was, and we gapped down. The futures show round the clock trading. These are the Globex futures, so show round the clock trading, and rallied back up, and it's been resistance. We tried, and we tried it with a divergent high. So even if they would have popped it a little bit more, likely these divergences would have caused that breakout to fail. And so far, we have a failed attempt again to get over there. And we have also moved down below the 31.47 level. This is the next support coming up, pullback target. Then and that's 31.14 and 30.80.50. And then down here about 30.45. So same levels that have been here for a while on this 60-minute chart at ES. And finally, the small caps, same story. Another failure here at 45.80 or 45-ish, 45 to 46. I covered this morning. We're still, that is today, if you want to do, today bears win, tomorrow bulls win kind of thing. Yesterday, well, nobody won because we stopped right at that 45-ish level. Today, a pretty impulsive move down, and it also coincided with a back test. Or a break, I should say, because we've been riding up this trend line. So now we're below it. We also failed at 45. So I'm going to give a little check mark to the bears today, but they need to take this level out. This is a big one right here, I think, 35.83 or so. Big old gap right here defining that level. Failure at that gap. Several failures to take it out. Finally, we broke out above it, back tested successfully, rallied, fell back down to it, held, tested it here. So that's the big level. And another way that I look at this is, like a lot of the indexes right now in sectors, it's this recent trading range. Definitive break up, bulls win. Definitive breakdown, bears win. And I'm talking about the next tradable trend. Anything, of course, other than whipsaws. I can't rule those out, but take it on face value if you get either one. Although the breakout might be a little more skeptical of for many other reasons that I've discussed recently, if it's an upside breakout. And last but not least, a subsector of tech is the semiconductor, or are they semiconductor stocks? There's stocks putting in a clear divergent high. This is a nice big divergent high right here. It's not really much different in scope than this previous divergent high that preceded this drop here. It goes down into the March lows. That was about a 37% drop. We had a series of divergent highs here. They played out for little corrections. Actually, this one was pretty decent. And the bigger picture, we go out to the weekly chart. It's just like the tech sector and QQQ as well. They didn't have, at least here on the the PPO, we did not have divergence on the weekly chart. They're very small. I should clarify. We had very small divergence right there on the weekly chart leading up to the drop, that 37 or so percent drop. Clean trend line break right below the rising wedge pattern. But at this point in time, we have much larger divergence building. And I still call it potential divergence because we need to see this PPO turn down and make a bearish crossover, meaning the blue line comes down, crosses below that white line. That will effectively put in a lower high. Lower highs on your indicators with higher highs on prices is what the definition of negative divergence is there. So there it is. Last time we had a divergent high there, it was pretty big correction came followed. And make no mistake about it, the semis are very cyclical. In fact, they tend to fall even more than the broad market. This is the stocks, the actual sector, the PHLX semiconductor sector index, that ETF. The ETF is SOXX. This is SOX dash X on TC2000. I believe stockcharts.com uses $, as they do for all indexes, and then SOXX. And you can see, back in the .com bubble, because tech was real frothy, the semis fell 84%. Back in the last bear market, from 2007 highs down to the 09 lows, the sector fell about 67%. So they are very cyclical, and tied in with the business cycle, and the corrections. You'll get more bang for your buck either being long during a strong uptrend in the market or in the tech sector, or being short when the tide finally turns. So there's one that's been on my radar for a while. We've had a couple shots, a couple hit and miss. Probably more misses this year on it, but in the past more hits, and usually big gains on this one. So this is what I'm watching. Somebody asked for some short trade ideas today, and that's one sector very much at the on the top of my list there. Oh, that's the. Let me go back to the ETF. SOXX, there it is. And of course you have the leveraged ETFs. If you want to do XOXL is the long one, the bullish one, and then SOXX is the inverse, 3 times short. And I'll give you targets on this. I haven't even looked at this chart in a while, so you can see I don't have anything. We had a false breakout right here. Since then, it's kind of just been grinding down as SOXX grinds up right there. So here's a clean board. I'll mark it up for you now since I haven't updated this chart. I'm not crazy about that trend line. I'm not crazy about the fit. but it works. Something to watch. You can see the divergence that's been building recently on this 60-minute chart, and I'll give you some price levels right now that are likely to come into play as support. So if you're looking for pullback targets on this one, I'm giving you those levels now. Yeah, let me put one more up here. I'm looking at the volume price histogram, and yeah, that would be it. So this is the pullback range right now, pending a break. Like I said, I don't have a super well-defined trend line, so it's hard to give a hard entry point. In other words, short under this trend line here or short below this. But with the divergences, everything else going on, and the Nasdaq breaking down, I think it's a good shot that this thing will roll over soon. And at bare minimum, you're looking for this pullback here at about 252.85, and that would be about about an 8% drop. And at this point in time, let's just say, and this may change, max targets there about a 22% drop. Let's see what that if that aligns with what I'm seeing on the daily chart. I have a big level down here about 247.77 that was color coded yellow, meaning that level needs to go to really give us a big sell signal on the market on the semis. Yeah, that'd be about a 10% drop there. And again, the divergences show that usually you're going to get off a divergent high like this at least a 10% drop, if not more. So I think that's a very doable target. I may have to sharpen my pencil on it there and add some other levels, but I'm going to leave it here. The market just closed. Get this out to you guys as, again, the closing market wrap, because we didn't really change much from when I started the video. SPY closed the day down. That's probably showing. No, there it is. Yeah, SPY closed down about 1% today. QQQ still leading the way, about negative 0.69%. And let's see what the equal weighted did. About the same today, nothing big. This is QQQE, puts an equal weighting on all the components of the NASDAQ 100, and you can see a clear divergence there as well. Okay, I'll wrap it up here and get it out to you guys. Have a great evening.